So yesterday, we talked about how there's conventional wisdom out there about what types of asset classes work in which types of inflation regimes. But we also said at the end that it turns out asset classes aren't particularly correlated with inflation one way or another. So today, I'm going to argue that part of the problem is that inflation isn't actually comparable across time. So it's very difficult for us to know which investments are best suited for today's inflation regime. All right. So as a review, yesterday we said again that certain assets are good in high inflation environments like commodity stocks, real estates, et cetera, and long-term bonds are pretty bad in low inflation or deflation environments. And kind of the opposite is true. Investment grade bonds, defensive stocks, dividend paying stocks, cash, et cetera, are pretty good, but commodities, real estate, and growth stocks are not very good. Well, let's look at inflation. All right. So here is the CPI over time in the United States, and we can see, that we've been as high as almost 14%, and we've been as low as just slightly negative here. So I guess the question is, what is high inflation and what's low inflation? Well, we could say, well, what's the average? If we have the average, we say, well, if it's above average, then it's high inflation. If it's below average, it's low inflation, right? So if that's the case, then we could say, for example, that back in 1956, we had a reported inflation of 1.5%. And in 2013, we had a reported inflation, again, of 1.5%, that these are comparable numbers. They're both in low inflation environments, right? All right. Well, the problem here is that the calculation methodology for inflation has changed over time, right? And the big problem is history is not changed to reflect the new calculation. Let me say that again. The inflation data, the historical data is not changed to reflect the current methodology. So that means old data is using the old methodology and newly reported data is using the new methodology. This is insane. It drives me crazy. There have been three major changes. In 1983, they went from this measure of, well, we're going to use housing prices to determine inflation to this kind of owner's equivalent rent. I think the idea here is we're going to smooth out inflation, that housing prices are a little more volatile than these owner equivalent rents. There was in 1998 this hedonics adjustment. So that basically says that, if you're buying something, say a TV, that you can't compare a TV from 1950s to, a TV now, that there's been so many technological advances that even though the TV, is 1,000 times more expensive, you're getting so much more bang for your buck. You're getting so many more things that there really is no inflation there. In fact, we'll see a lot of times that they'll say there's deflation in a lot of electronics because the advancements are so valuable that there's deflation. Now, of course, they don't go back in time and say, hey, this thing's now a collector's item, so the old one is worth $1 million. Now we have to, jack inflation up. They never, of course, do that. And then in 1999, they introduced kind of this crazy product substitutions. So, if inflation is too high, say, well, you're not going to keep buying the same goods. You're going to go from, you went going from your filet mignon to some cheap ass ground beef. And there's going to be no inflation because they both double, but now the ground beef is the same price as steak, and so there's no, you substitute for the crappy item, but no inflation. It's completely preposterous in my mind. I think there's even something in there that says, if a candy bar is 1,000 grams and it costs $1, and they change it to 50 grams for $1, it's still one candy bar, even though you're getting half as much. No inflation. That's pretty preposterous, if you ask me. So those are the changes. So now if we look at kind of inflation over time, we're going to go back to this 2013 number. Now, some people have calculated, what the effects of these changes are. So if we look at 2013, we had an inflation rate of 1.50. Now, if we revert back to the pre-1990s changes, and we did make the same calculations, we're seeing the inflation was actually 4.8% back in 2013, which now is an above average inflationary point. If we then revert back and take away the 1983 adjustment, inflation all of a sudden now is 8.9%, which is one of the all-time high inflation points. So when you think about, hey, we had these crazy high inflation numbers in the 70s. Well, we actually have the same numbers now if you may have the same calculation. There's another guy out there who does some calculations and he says, well, I'm going to do it a little bit differently, but for my calculations in 2013, inflation was running at 7.7%, really high. And of course, interest rates were really low. So some of the people who say, hey, these low, interest rate environments are going to create inflation, but we're not seeing it in the numbers, maybe because the numbers aren't right. All right. So again, to me, this is it's no wonder to me that there is, the asset class of returns and inflation are not correlated, because inflation hasn't been calculated the same way over time. So inflation isn't even correlated with inflation. So I would argue that given the lack of correlation and the lack of empirical evidence, you should probably discount kind of the conventional wisdom that this asset class is good in this environment and this one's bad, and vice versa and whatnot. Anyway, I hope you enjoyed that. Gives me an idea for another post where I'll have some fun kind of ripping into the Fed. Thanks so much for listening.